Financial ratios and ratio analysis. Before we get into the individual ratios and how they're all calculated, we need to spend a minute talking about what ratios are, why we have them, what we do with them, and a few rules and guidelines about calculating ratios, and then finally what it is you need to be able to do with ratios for the exam. So we start with the question, what is a ratio? Well, we need to understand at the very beginning that a ratio by itself is only a number. It's only a number. If I tell you that debt to equity ratio is 2, or I tell you that the current ratio is 1.7, that by itself is just a number. It doesn't have much value by itself. Now, there are industry expectations or industry averages where we can say it's well below or well above the industry average, but it's missing a lot of context if it's just an individual number by itself. So in order for ratios to have value, that number needs to be put into a context. We need to add a little bit around it so that it has more meaning. We need to compare it to something. We may compare it to the same company over time. We may compare it to other companies, or we may be comparing it to management expectations. And so if we get the ratio, we get the number that says it takes us 48 days to collect our receivables. 48 days to collect our receivables. Is that good or bad? Well, it doesn't sound very good. But then if I tell you that our credit terms are 60 days, we give our customers 60 days to pay us, and it takes 48 days on average for them to pay us, it's pretty good. If I tell you that our credit terms are 10 days, they're supposed to pay us in 10 days, and it takes them 48 days to pay us, then it's pretty bad. If I tell you that it's 30 days, our credit terms are 30 days, and we find out it takes our customers 48 days to pay us, that's not good. But if I tell you that last year it was 72 days, well, it's still not good, but we're certainly moving in the right direction, and it's better than it was before. So to give that number, that ratio that we calculate, just that individual number there by itself, value and meaning, it needs to be compared. Us over time, the same company over time, other companies, that industry average. What we expected it to be, what our target was, what our goal was. We may have achieved the goal, we may not have achieved the goal. But you need to keep in mind that just a ratio by itself is just a number. And it doesn't have meaning until we put it into a context one way or the other. Also, we need to keep in mind when we're looking at a lot of these ratios, they're based on accounting data. They're based on accounting information, the numbers we get out of the financial statements, out of our accounting system. And so different accounting methods will give slightly different ratios. If we use FIFO, or weighted average, for our inventory, whether we use straight line depreciation or double declining balance for depreciation, is going to give us a slightly different depreciation expense, which will change profit, which will change the book value of our fixed assets a little bit compared to the different methods. So we need to keep in mind that different companies, if we're comparing companies, may use different accounting methods which may give them slightly. Okay, the difference between FIFO and weighted average isn't going to be huge, but there may be some slight differences in the ratios simply because of the accounting methods that companies are using. Additionally, when we're talking about accounting information, a lot of that is historical cost. And so if we're using this historical cost information to put into our ratios, we may not be getting current values at all. That's what our book value is of our fixed asset, but that may be very different from what the current fair value of that fixed asset is. So we just need to keep this in mind as we're looking at ratios and making comparisons, that a company that has brand new fixed assets, that just replaced its fixed assets last year, is going to have a much higher value to its fixed assets on its books than the company who's going to be replacing its assets next year. Because that company who's going to replace the assets next year, their fixed assets are very depreciated. So that book value of the fixed assets is going to be much lower. So things like that are going to impact the ratios that a company has. We have a couple of rules we need to be aware of when we're calculating ratios. The first is if we have a ratio that includes balance sheet amounts and income statement amounts, we need the balance sheet to be an average balance. Okay? The income statement is a year. The balance sheet is a picture in time, a point in time. And so if we're looking at balance sheet and income statement numbers being compared, we want that balance sheet number to be an average. Now, the simple way we take an average is beginning plus ending divided by 2. That's most likely what you would have to do on an exam. They'll give you the beginning balance, the ending balance, and you calculate the average balance. So when we're comparing balance sheet and income statement amounts, those balance sheet amounts need to be the average balance and not just the year-end balance. And if we have an income statement amount that's for less than 1 year, we need to annualize it. So if we have the quarterly income, we need to multiply it by 4. Okay, we're presenting all of these income statement amounts as a whole year. So balance sheet amounts need to be averaged, income statement amounts need to be annualized if they're not. Now we also need to keep in mind that different companies may have different ratios. And if I were to ask all of you to, if we were sitting in a classroom, ask all of you how your company calculates a certain ratio, some of them be very, very similar, if not exactly the same, but there'd be variance in some of the ratios. What's included as a current asset, what's not included, what measure of income we use in a certain ratio calculation. So in the real world, different ratios may be calculated in slightly different ways. And that's just kind of the reality of that. The IMA, fortunately for us, has published the ratios that you need to know for the exam and the formula for those. And that's what we have in our material. You don't need to go find it. We've done that for you. The ratios we're going to be giving you are the ratios in the way that you need to calculate it to get that exam question correct. If it's a little bit different than the way your company calculates it or the way you've seen it calculated in other places, that's fine. It's not that anybody's wrong, but on the exam, these are the formulas, these are the calculations for all of the different ratios. Okay, so this is what you need to know for the exam, even if it's a little bit different than what it is that you see elsewhere, what it is that you do in your company. Now, before we get into the ratios, just kind of click through the different categories of ratios. We have 5 different categories of ratios, and that's how we're going to break them down and look at them. We have liquidity ratios, which is measuring the company's ability to use its short-term assets to meet its short-term obligations, kind of keeping those payments being made as they need them. And we have leverage or capital structure and solvency ratios, longer-term debt, investment obligations, how it is that the company finances itself using that financing, activity ratios, managing current assets and current liabilities efficiently. We have profitability analysis, different measures of the firm's profit in relation to its total revenue or assets, profit from sales and things like that. And then we have market ratios and earnings per share analysis or shareholder ratios, okay, looking at the financial conditions in terms of stock values. Okay, so we've got different categories of ratios. Went through them quickly there. We're going to look at each of them in more detail and all the ratios for each of them in more detail. But this is kind of a way to help organize all of these different ratios that you're going to have as you go through it. Now, there are a lot of them. So what you need to be able to do on the exam in respect to ratios is you need to be able to calculate the ratio. Okay, there's something divided by something. You need to understand what that ratio is telling us. What information is that ratio giving us? And you may need to be able to identify a way or ways in which the company could improve that ratio. What is it they need to do? They need to increase sales. They need to decrease expenses. They need to get more current assets as compared to long-term assets. What is it that they can do that would help that ratio become better? And what is better for that ratio? The main step in this is calculating the ratio. You will have to calculate ratios on the exam. Okay? Whether it's in the multiple choice questions, whether it's in the problems and essays, there will be questions where it will ask you, what is this ratio? If you know the formula, it's easy. It's quick, you get it correct. If you don't know the formula to calculate that ratio, you're guessing. You have a 25% chance of getting that question correct. So you want to make certain that you know how all of these ratios are calculated. For these ratio calculations, the names are descriptive. That's a big help for us. And we'll go through as we'll see that a lot of the names are descriptive. But also flashcards. Okay? If you want to use our flashcards, if you want to make your own, just on a piece of paper, one side is the name of the ratio, the other side is the formula for it. You need to be able to calculate these, because if you know the formulas, it's free points on the exam because you're going to get it right. You're going to be able to calculate that ratio, you're going to be able to do it quickly, but you have to know the formula to be able to do that. So please, please, please make the investment in the time to memorize the formulas. I said before, I'll say it again. A lot of them, the name is descriptive, and the name itself kind of tells you how it is that you're going to calculate that ratio. So some of them are very easy to memorize. Some of them are ones you already know, that you've looked at in other contexts. But make certain you know these ratios, because if you know the formula, these questions are going to be easy, and you're going to get it correct quickly. So know the formulas, know how they're calculated, know what it is that the ratio means, what information it's giving us, and then what it is we might be able to do to improve that ratio. That's what you need to be able to do. And what we're going to do next is we're going to turn our attention to each of these different 5 categories of ratios and talk about them, talk about the individual ratios, and go through all of the formulas. But that's what we'll turn our attention to next.